You ever think a stock might be ready for a breakout, but you're not sure what direction it'll go? Well, at that time, you can play an options strategy called the Strangle. Now, you've probably gotten here by typing something like Strangle Option strategy into Google or into Yahoo, and I'm going to tell you exactly what that is and how to use it and what the advantages of it are. But first, I want to point out that I'm going to do this in a context of gap trading because that's mainly what I trade. I trade these price gaps that you'll see in Cisco systems here. We've got a huge gap right there, and based on gap theory, you can analyze the volume and you can analyze the candlesticks and be pretty sure which direction the gap will go. But in some cases, you'll see that the indicators of the gap, for example, the volume here indicates the gap is probably a breakaway gap, which would allow Cisco to keep going up. But the candle here looks kind of like a bearish meeting lines and almost like a dark cloud cover, which would say that the stock's going to fall. Now, gaps usually will fill. So usually you're going to see this area be filled by a downward trend. But often the gap stays there for a long time, and a gap with a high volume brings the stock to new highs or new lows, depending on whether it's an up gap or a down gap. Now, you can capitalize on that many ways, but one of the best ways is the Strangle Option strategy. What a Strangle Option strategy is buying a call and buying a put at the same time around where the stock is trading currently. So you're buying two out of the money options, which are cheaper than normal stock options, because you believe that there's going to be a breakout in one direction or another, but you're not sure which direction. So here's an example. Cisco Systems is at an all-time high. We just had what looks like a breakaway gap. So we're going to see it, we might see it touch new highs where a call option would behoove us. But at the same time, gaps tend to fill statistically. So we might be scared that we buy a call option and we lose money because the gap ends up going and getting filled with a bearish trend. So what we do is we buy a call option above where it's trading now, and we buy a put option below where it's trading now. For gaps, usually the best course of action is to buy a call option, for an up gap anyway, is to buy a call option right above where it's trading. So I would buy one at 30, and to buy a put option where the gap would fill. So I would actually buy it below this candlestick. So I've done a bit of an analysis on the options, and what I came up with were two options to make the strangle with, and they are at the strike prices of 30 and 26. So just based on my inability to correctly predict which way the breakout will be, I would go with a strangle strategy. Now, when you go with a strangle strategy, you are getting the benefit of the out of the money part of the call because they're going to be cheaper than normal. You can see the put's only $50 per option. At the same time, as long as one goes in the money, you usually will be profitable. So if the gap does fill and it goes down below 26, you're probably going to make more. Okay, for example, here, if it goes down to 25, you're going to get $100 extra on this put, minus the time. Well, I'll talk about that in a second. You're going to get an extra $100 on the put, which will make up for the $100 you put on the very close call. So you're going to break even at about 25. Now, for the call, if the price keeps going upward, you're going to break even pretty much as long as the stock goes above 30. So you have two very nice break-even points. One is you break even if the gap fills and continues downward. The other is you break even if you reach new highs. Now, there's something in options that is frightening to some options buyers, and that is the expiry. The expiry date, the closer you are to it, the less value that you get from it as the time continues to go by. So for example, if we are in March right now. If we bought a March option, we would be losing money if the stock stays more or less at the same point for a while. But when we buy one far out, for example July, we can actually wait a while before that breakout occurs and still be profitable. So I recommend when you play these strangle strategies, you buy them a few months out. So I'm going to put this in my brokerage account. I'm going to show you exactly how to put a strangle option in there. So we're going to do Cisco Systems. Actually, what you need to do first is you go to wherever you can open an options spread. So I go to spreads. Once you go to spreads, you type in the symbol. Cisco is this one. You're going to buy open and you're going to buy open. We're buying two options. One's going to be a call, one's going to be a put, and we're going to go with the expiration date a few months out. So I'm going to go with July. And then the strike prices are the ones we saw. The call needs to be the higher of the strike prices, so 30, and the put needs to be the lower of the strike prices, which would be 26. And you're going to see the midpoint is $1.46, so you put a net debit. We're paying for these options, and you put in the midpoint. That's it. And you put that order through, you're going to be paying $146 for this play. And basically this play allows you to profit in the case of a breakout, regardless of the direction. That is the strangle strategy. If you want to learn more about trading gaps and trading options, please check out my website. You can get a free guide on trading gaps just by putting in your email address. Leave your comments below. Take care.